The challenge for us at the moment is we're continuing to grow strongly. There's been a bump up in labour costs and will be in the next 12 months. Not unrelated to the union recognition in December, but really there's a higher rate of pilot turnover at the moment in the industry across Europe. All the airlines are saying pay is rising rapidly. We've secured 5-year pay deals with the pilots and the cabin crew. We're well hedged on oil into this year. We're hedged at $59 a barrel. Current spot is close to 80. But I mean, if the oil continues at these elevated levels, we're clearly facing higher oil prices, not in FY19 but in FY20. And the question is who survives this winter, or what casualties that will bring, because clearly $80 a barrel oil is going to bring casualties in Europe this winter.
What are the ins and outs of trying to hedge when you don't know whether the price is now at its peak and about to roll over and come back, or whether there could be more upside for the oil price? How do you get your head around the type of hedging policy you need?
Like, our hedging policy has been pretty consistent over many years. What we try to do is roll forward, be 90% hedged 12 months out. So at least we have certainty on costs. And we are essentially price takers on oil. At the moment, we are now 90% hedged for the full fiscal year out to March of next year. We're hedged at $59, but we have very little hedging in place, less than 20% for the following year. And we're now facing forward rates in the mid-70s. So oil is going to be a driver, but I mean, I think it'll be a driver of change in the competition landscape in Europe. Some of those airlines who couldn't make money when oil was at $40 a barrel last year, I don't think will survive this winter if oil remains up at these elevated levels.
So just let me come in on that point. You think Norwegian's going bust?
Yeah. I mean, if you couldn't make money at $40 a barrel last year, they're unhedged. Oil is $80 a barrel. I think it's inevitable. It either goes bust or it gets taken out or reformed.
Is it just Norwegian, or are there other players you're suggesting?
No, there's other players. I mean, I think I don't want to name them all on television, but you don't need to be a genius to look around Europe and see who's been losing money for the last number of years. Alitalia, for example, is in administration. You have TAP struggling. There will be a number of players who are going to suffer. And I think that, that may be, we haven't built it into our numbers, but it may well be if there's a significant kind of restructuring of the industry over this winter, driven by higher oil prices, then I think the capacity growth environment may stall, which may be good for the outlook on fares. At the moment, we're pessimistic on fares because capacity growth continues to be above average.
You say Norwegian is going to go bust or be taken over. Is that a deal you would jump on?
No. I mean, I thought that the best description of Norwegian, or Willie's 5% stake in Norwegian, was like catching a falling knife.
But you can see why it's good for British Airways or for ICAG, can you, or not?
Yeah. You can see there's the structural reasons behind it. The thing we would question is timing. If this thing is going bust, it is a huge bond for them. It is net debt of about over €4 billion. You let it go bust, and at least then the bonds holders get restructured. Now that you have IAG though stepping in and putting it into play, there's a possibility that Lufthansa may also enter the fray. I think the bondholders will be emboldened to strike a tougher deal.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.